On today's Hashi, I'm discussing housing inventory, new construction prices, Friday's unemployment report as well. Today is Monday, July 8th, 2024. I am Byron Lazine, and the Hashi starts now. Welcome back. After a long holiday weekend, we were off obviously on Thursday to honor July 4th as markets were closed, but glad to be back here. It's your only 24-hour look back on the housing market every Monday through Thursday that the markets are open. We go 9:30 on the east, 6:30 on the west. Share this live stream with someone who wants an update on the housing market and all things real estate in a 24-hour window. Let me know in the live chat which market you're tuning in from. If you're listening to the replay, love for you to consider leaving us a review for the Hashi on Spotify or Apple. And if you're just like coming into this Monday and you're thinking, wow, I wish I had one last barbecue, one last, 4th of July party. Well, I've got good news for you. Next week on Wednesday, July 17th from 12 to 3 Eastern, we have the BAM barbecue. Okay, no need to say that Sunday or Saturday was your last barbecue of the summer. July 17th, Wednesday from 12 to 3 Eastern time. Sign up for the BAM barbecue. It is a free virtual event. We have Samantha DiBianchi from the Fort Lauderdale market, as well as Luke Cree, Chris Smith. We're going to be giving away some of Chris' conversion code books. Tom Toole talking about time management. Paige Steckling giving her secrets on what makes her listing videos so great and why they actually convert. I'll be there, as well as Eric, the broke agent, and Luke, actually agent. So sign up. Haley will put the link below. It's completely free virtual event next Wednesday, July 17th. Love to see you there. Now let's check out inventory here for the week. It's how we kick off every single Monday. Every single start of the hot sheet week, we take a look at inventory. Inventory is much better position than last year. Still well below historical averages. So inventory on the whole can still, some parts of the country feel really low, really shallow, where other parts of the country can feel elevated. In fact, there are some parts of the country that are above pre-pandemic levels. But let's take a look at the whole here for last week. Last week, we saw an inventory increase of 6,800 plus active homes on the market. 6,800 is off, wanting to be above 10,000. That's where Logan Motoshami has put his metric, looking at over 10,000 per week could be the ideal number to get to. So we fell short of that. And we've been hitting 10 plus thousand here, it seems, for a number of weeks, for a handful of weeks anyways, recently. It's why we've had such a great gain the last month and a half or so. So we're sitting at 652,500. That's off of 645.7 last week. Same week last year, we were at 466,000. So we're 28% more on active inventory than this time last year. And when we look at from now, 24, all the way back to 2017, we see we are about to cross over 2020 inventory levels. So we're even with 2020 inventory levels, according to Altos research data. Of course, 2020 was on a nosedive down at this time. So we are officially at 2020 levels. Next week, we will be above 2020 levels. Not that impressive when you consider the second half of the year in 2020 was a nosedive down. It was unlike almost any other, when you should still see some increase during the July, August, September months before the seasonal November, December decline on active inventory, which we see every year, of course. Okay. So we're sitting here at 2020 levels, 28% more than 2023. 2023, of course, one of the most shallow inventory markets of all time. 2022 was the peak bottom, March of 2022. before rates went up. That was the absolute lowest inventory levels. 2023 was driven low inventory by the lowest level of new listings ever recorded. So going to new listings, let's take a look at where we ended up last week. We had 71,000 new listings last week, which was much better than the 58,000, which again, these are all-time low numbers when we're working off of 2023. If you look at 22, we were more in a historical norm at just under 90,000 on new listings. You see about 90 to 100,000 would be a historical norm. So we're still well below that at 71,000, but continuing to bounce off of the historical low of 2023. Now we're going to get into probably in a month or 2 months. We're going to really start to see new listings take a sharp decline through the rest of the year. It's the seasonal decline that you would expect. And you would say now we're at that seasonal peak for new listings. This is kind of the top. So you've got like the summer. Some markets, you get a little bit of a September, late August, early September pop in new listings, but you've got about 2 or 3 months here. If you're a real estate agent, if you're a listing agent, if you're looking for new listings, to accumulate inventory, to sign listings for your business. You've got a 2 to 3 month window. I get it. There's 6 months left on the calendar, but in terms of generating listings, of signing listings, you're really looking at 2 to 3 months for the majority of the listings that are going to come on the market. Will you list something in December? I'm sure you will, but you're going to get a much bigger pie to take a bite out of in the next 2 to 3 months. Okay, so keep that in mind. We're at the seasonal peak, and that means the seasonal decline is coming on new listings. It also means that it's going to be hard for us to really make up a significant amount of inventory here throughout the rest of the year coming into that seasonal decline. I had hoped for maybe, my aspirational number, like sellers have aspirational prices. My aspirational number on inventory was 800,000. That would put us, up here on this white line, where we kind of ended 2019 just under 800,000. I was hoping we could peak out there at the end of summer before we start our seasonal decline on active inventory. There's no way we get there with kind of where new listings are trending. Looks like we can get to probably low 700s this year before we start our seasonal decline at best. And that's if we got to have some more weeks at 10,000 plus on the active inventory number as we move through the next few weeks in particular. All right. Price cuts for the last week. We're seeing 38% currently. Price cuts before sell. This is a percent of properties with recent price reductions, according to Altos research across the U.S. On a normal year, you get about a third. Last year at this time, we had 33% and 22. At this time, we had 32%. 22 was on its way up. As rates were on its way up, price cuts were on their way up. So with elevated rates higher for longer, you're seeing price cuts at a higher scale than you normally would see at the 38%. And that's an interesting, I think that's an interesting point about the market. Okay. And it's where we've got to be careful and be very hyper local on how the market's reacting when we're talking to consumers, because you've got 38% of people who want to sell that are making a price reduction when normally it's a third, but yet we're still well below historical averages on inventory. We're at 650,000, and getting to 850,000, 950,000 is a much healthier place on active inventory. So why are more people cutting when you have actually less inventory than looking in the rearview mirror in years past? Well, it's because you have significantly less demand right now. Okay. As much as we want to say, well, the demand's on the sideline and it's coming, and that probably is true, the demand over the next 90 days just isn't that strong. And it hasn't been strong all year. It's been well below 2023 levels of demand, 2022 levels. Okay. This is some of the lowest demand in terms of mortgage applications in decades. Every week we look at mortgage applications, and we're looking back to 1995 to see this level of new purchase, not refinance. Refinance is like year 2000 is where we're at. But new purchase applications, you got to go back to 1995. So the demand isn't there, and that's why you're seeing the people that need to sell, those folks that have to sell, are dropping that price because the sales just aren't there. There aren't enough buyers pending properties for them not to make that move down on the price cut. In fact, you've got 381,000 total home sales pending right now, according to Altos Research, which is basically the same as last year. Last year was 381,000. In fact, they say 3.2% more single-family homes were in contract now than last year, but you see the numbers here: 381,036 in 23, 381,057 right now. It's basically the same amount of homes under contract today, yet we have over 200,000 more homes on the market. So inventory is staying on the market longer. It's starting to build up, and you're seeing the same amount of buyers pen these properties as you did last year. In 2022, you had 420,000 at this time, and the interest rate had already gone up by this time in 2022. Yet you had 420,000 pending homes. Now you could also say some of those were pending from a surge trying to beat the rate. Absolutely true. These high rates have certainly suppressed sales. That is the recession of our time, the real estate recession, in terms of sales, not sale prices. The suppression has been sales, and that continues today. And if we're just basing it off of mid-22 to today, we don't see sales come back in a significant, meaningful way, meaning total transactions come back in a meaningful way, until we see interest rates come down in a more meaningful way. So Logan also wrote in the piece here, the housing market is better positioned for lower mortgage rates. So if we do get the lowering of mortgage rates, we won't be in a 22 level because we have a higher level of inventory, and hopefully we'll continue to see that hit the market. If you want more on that breakdown, of course, you can grab everything inside of your hot sheet show notes, which are available inside of BAMX. We deliver our hot sheet show notes each and every single day inside of BAMX, as well as all of the slides and everything will be carved out there for you. If you're not a member of BAMX, use code HOT to get your membership activated into BAMX. All right. Lance Lambert over at Resi Club did an analysis on what home builders are saying about prices. The average cost of new construction of a new home has been higher and always is higher than existing homes. Now, as existing home inventory increases, made the case here that you're going to start to see home builders have to reduce their price. They're going to build less. Their home starts are going to start to tighten up. We've seen that. Now we're seeing them actually say it about home prices. 10 of 11 leading home builders witness average sale price decline since the pandemic housing boom peak. So 10 of the 11 leading home builders are saying prices are down. D.R. Horton, average sale price is down 4% since quarter two of 2022. Excuse me. Pulte is down 5.8% since quarter four 2022 peak. That was their peak. KB Home's average sale price is down 5.4% since its quarter four 2022 peak. And Lennar, their average sale price is down 13.2% since their quarter three 2022 peak. Okay, so here are the change on a diagram here. Change in the average sale price among 11 major publicly traded U.S. home builders. If you're in a market that's got a lot of new construction, this chart's available for you inside of BAMX, so you can grab it. Okay. Here's since quarter one 2020 down on the right, down from the peak You can see there Lennar is down again 13%. Meritage Homes is down 15% since the peak. LGI Homes is the one outlier, not down, so they're flat at 0% LGI Homes. But DR Horton, KB Homes, Pulte, Taylor Mason, Century Communities, Toll Brothers, they're all in that mix of being down 2 to 8% on their change in average sale price from their peak. So LGI Homes is the one outlier. Again, everybody else down on their average sale price. And to me, this just shows you, and here's another look at how it's broken down here. You've got Toll Brothers in 2020, quarter one at 843,000. They peaked out at 1.1 million. Now down to 1.040. Taylor Morrison, 458,000 to 650 to 599. Okay. Pulte Group from 413 to 571 to 538. A little bit of a tighter range there on Pulte. But LGI really playing in that lower price point. 247 was their average price in 2020. Their peak was 360, and now they continue at 360. But you're below the median price point, so that makes sense to me. That they're gonna be safer than some of these other ones like Toll Brothers, who pushes price. Taylor Morrison pushing price a little bit there on the average sale price. But this is just another indicator that you're going to start to see, and you'll see it the second half of this year. We have the inventory that's sitting 200,000 more homes than last year with the same pending sales. You're going to start to see, price have pressure to either flatten out or even some downward pressure. And you're seeing that in some markets, for sure. So this is another indicator to that. I've been calling it. Price is going to have a lot of pressure in the second half of this year. And if the builders are already saying it, expect it to show up in the data here as we move forward in the next couple months. It's why if I'm talking price with a seller and we're not planning, I want to use the house for the summer, I'm going to go on, the market early fall. Just understand, Mr. and Mrs. Seller, that we are in a flattening of price. And for price to flatten, it means that over the next couple months, it's likely declining. Okay. There are not many markets in the US that I would say are going to see a significant or meaningful acceleration in price through the summer. I think there's enough pressure to flatten prices almost everywhere, or even to the downside. I'd love your thoughts in the comments, whether you're here in the live chat with me right now, or if you end up listening to the replay and you want to put it into the replay comments. What are you seeing on price? Do you expect a flattening or even some downward pressure as we move, for those serious sellers, the people that actually want to sell within a timeline rather, as we move into the summer? Okay. All right. As we continue to move through the summer, we're watching for things on inflation. We're going to get Jerome Powell testimony tomorrow. We'll cover that on Wednesday. But we're also looking at the job market. And there was an interesting piece of data on Friday as unemployment came out. It increased 206,000 in June. We're starting to see, a little bit of a slight uptick there on unemployment. But the bigger news was the number 4.1. Yeah, it's 4.1% now on unemployment. Okay, that's up from the expected 4. It was supposed to stay at 4. It's at 4.1. This isn't sky's not falling. We're not talking about a recession, anything like that. Just talking about the interesting data point that unemployment, while expected to stay at 4, is now at 4.1. It is continuing to show signs of increasing gradually of a softening labor market. These are dynamics if the labor market gets softer, or if unemployment goes up more than expected, as it did 4.1, but even more than that. These would be you'd start to hear talking points of, hey, is Jerome Powell going to start? Is the Fed going to start cutting the rate? Because they have two mandates. It's get inflation down to 2%, but it's also maximize employment. And they don't want to see an employment issue here in second half of 2024 in particular. They do not want an employment issue. And so that would be one thing that could get a cut maybe as soon as September as the market continues to wait for these rate cuts. So interesting there that we saw a miss on unemployment. Still, fairly good number, but a miss nonetheless. 10-year Treasury sitting here as we enter the week at 4.293. That's kind of, I guess, up and down a little bit, up and down in the last day, but down over the last 5 days. So 4.29 on the 10-year. We'll obviously see how the 10-year reacts going into Wednesday morning after Jerome Powell's testimony, see what kind of tone he takes with some of the decent inflation data that we've had recently. The end of the week last week, on Friday, we had 7.03 on the 30-year fixed mortgage news daily survey. The Freddie Mac 30-year weekly survey came in at 6.95 for the week. So that's really been where we've been at for the better part of 2-3 weeks. We've seen a couple pops to 7.15 range. But we're sitting here at about 7 consistently here on the 30-year fix. That's where we've been for 2 or 3 weeks. And we're also seeing, that impact the market. It's impacted. This 7% is a level that impacts pending sales, keeps them very, very low, historical low levels there. It keeps new listings kind of suppressed because a lot of people selling are obviously going to be, buying. And so this is having this impact on the market, and we won't see really a significant movement on those transactions until we see the rates come down. We won't see the bump up on transactions until we see those rates come down, and there's no indication that that's going to happen anytime soon unless we get one of these breaks in the labor market, which is why I think that 4.1 is an interesting miss. Have to see a little bit higher number, I think, to get Powell to react quickly, but we'll get Powell commentary tomorrow. We'll cover it on Wednesday, of course. That is your kickoff here for the hot sheet. Hit the thumbs up. Make sure to subscribe to the BAM YouTube channel and share the hot sheet with anyone who would like a 24-hour look back on the housing markets. The only show on the internet that does it every single Monday through Thursday, live 9:30 on the East, 6:30 on the West. And until tomorrow's hot sheet, of course, have a great day and toodaloo.